most of the time in business, okay, whether it's public or private, the company will just decide to let suppliers compete for a contract. This is where tenders and competitive bidding comes in. See, the idea is, okay, you need something done. And so you put out an expression of interest, or rather you put out this information saying that if you're interested in solving this problem for us, okay, or if you're interested in supplying these things, then express your interest by submitting a bid. So that will be in the form of tender bids. And, well, it's an entire process. What do buyers generally look out for during the tender evaluation, and what does that mean to the suppliers or to the vendor? So if you are, a supplier, or rather if you have a business, maybe you're doing IT or whatever it is, and you want to get some of these tenders, right? You are bidding for a contract. Then the first thing you need to understand is that whatever the buyer is looking for will, for the most part, depend on the specifications that were set out during the design stage, okay, when they're identifying needs and designing the specifications. But having said that, the one thing you can bet on, okay, despite all of that, is that the buying organization is looking for a supplier that is offering the best value for money. The evaluation process typically involves a team who have the necessary skills like financial expert, technical expert, purchasing expert, and even a legal expert. So the point of this video is just to put you in a position to understand how the buyer is going to be evaluating these tenders and some of the things that you can do to increase your chances of getting the contract. So let's go over some of the things that are likely to be assessed and what you can do about it, okay? So during the tender evaluation process, what is the buyer likely to look out for, and what can you do about it to increase your chances of, getting that deal? So the first one is financial assessment. And in this case, the assessment is going to be based on things like whether or not all costs are covered in the price offered. You see, most people tend to be of the notion that if they quote a higher price, then they're going to miss out on the deal, right? True. But then again, what if you quote a lower price and then you get the deal? See, there's a problem there, right? So now you've been awarded a contract, and the problem is that you're doing that contract knowing well that you're not going to meet your margins, or the margins are properly minimal. So the first thing to ask yourself is, are all costs covered in this price? That's the first thing you need to know. Okay, it's not just, I want a website and then you just say, well, it will cost you X amount. No. Are all costs covered? Because they are going to look at that because they know what they want. And sometimes they even ask you to break down the cost. Now, the other things will include currency conversions are at the correct time, alternative costing for alternative supply methods are identified, discounts are offered where appropriate, terms of payments are included, costs of spares are included in the offer. And in fact, let's look at a practical example, okay, so that we understand all that. So in this case, let's assume that company XYZ, which deals with renewable energy, is looking for vendors to supply and install solar panels for a new solar farm. So the project, installation of solar panels, right? And they've gone through the bids, and now it comes down to two suppliers, right? So the company, in this case the buying organization, has to make a choice between two suppliers. So let's call them supplier A and supplier B because we are very good at coming up with names, right? Now, from a financial perspective, this could mean looking at things like current assets and current liabilities. And so that's just part of the liquidity ratios, right? So maybe they're looking at your financial papers and they're like, okay, let's look at these two companies' relationship in terms of, the working capital. So in this case, current assets and current liabilities. And so they're going with the current ratio, right? And that means current assets divided by current liability. Meaning, if vendor A current assets are $500,000 and current liabilities are $300,000, then the current ratio is going to be 1.67. And B, so let's say if vendor B's current assets is $600,000 and $250,000 in terms of liabilities, then you have 2.40. What does that mean from a financial perspective? It means that vendor B is since 2.4, right? So they are twice likely to pay out their business, the debts within that business period, okay? Remember, with current assets, current liabilities, working capital, you're talking about your business period, or rather your business year is more appropriate, right? So they have enough money to take care of their debts within that financial year. So twice as much as, supplier A. So in that case, we are more likely to go with supplier B. But of course, you need to know that some of these math thing can actually just be as a result of having one big client. So it's not like this is the only thing you look at and that's it. But from a numbers perspective, vendor B in this case makes sense. Solvency ratios, profitability ratios are other financial ratios that can also be looked at, in addition to things like credit risks, operational risks, and market risks. Now, that's accounting, right? I mean, remember it was finance. We are assessing, at this point, you're assessing the tender from a financial perspective. So what does that mean to you, okay, as the vendor or as the supplier? Then it means there are things you need to do, okay? What kind of things? For example, improve liquidity. There is enhanced cash flow management to improve the current ratio. Reduce your debt. So this one you can just decrease liabilities to improve the debt to equity ratio. Financial transparency, meaning provide detailed financial reports and audits, okay? And then again, there is a track record. So provide case studies and reference to demonstrate successful projects you've done in the past. So, because in this case, you're just saying, look, we may look this way, right, on paper, but in reality, here are things we've done, and these things, testimonials and things of those nature will go a long way. In some other cases also, right, in some other instances, you might not be in the financial position that you'd rather be, right? And it helps to provide guarantors. In fact, some buyers, okay, as part of managing supply chain risks or whatever it is, may insist that you provide a guarantor, okay? Or, well, it depends on the nature of contract. Like you can have a situation where you're tendering for a construction, right? So it's a construction project. And then they say, well, this project is so big that in as much as you look like if you can do it, we want some surety that if things go wrong, you'll still be able to do it. And so come up with a guarantor. So these are scenarios where guarantors can also step in and help you. But look, it depends with the contract. So the point here was, okay, number one, if they're assessing your tender in terms of finance, then there are those things that you can do, so do them. Now let's move on to the second one. Technical assessment, and this is where, the experts will come in to technically assess whatever it is. And so for the most part, this one will just depend on the tender you're going for. If it is a government thing, okay, it depends. Like it's a local council thing where you're bidding for a tender to, like a garbage collection deal, okay? Or, in that case, the technical expert may just be something to do with the environment, right? What about road construction? Okay. What about disposing, say, hospital waste? Okay. Like those chemicals and stuff. What about security? It depends on the level, right? So the point is, depending on the tender that you are going after, or depending on the contract that you're going after, the level of technical experts that are needed will, for the most part, just depend on that, depending on the contract. But some of the things that they might look out for will include production capacity claimed, physical inspection of the production site if necessary, all life asset including decommissioning, removal, or disposal. Again, to understand these, let's look at a practical scenario. So in this case, let's assume that company X is looking for a new ERP, that is Enterprise Resource Planning System. And several suppliers have submitted the bids. And so in this case, the assessment could come down to things like detailed technical evaluation, which will mean how the ERP system, okay, meets the specified functional requirements, technical architecture, where they're looking at things like scalability, okay, and flexibility, ease of integration. We have performance and reliability, that's another thing. Security, okay? Remember, it's a system. So how secure is that system? Especially if it is a system that is going to integrate with the other aspects, okay, of the business. Because, maybe it will integrate with accounting. So what if somebody hacks it and then ends up messing up our finances and things of that nature? So security, big deal. They can also look at whether the vendor offers support and training total cost of ownership, that's another thing. Now, when they're looking at all those things, right? So from your perspective as the supplier or as the potential supplier, what are things that you can do to boost your chances or to increase your chances of getting contracts or rather landing these deals if they're going to be evaluated by experts? So in this case, you can do things like making sure you submit a detailed proposal that clearly shows all specified requirements, okay? Highlight your unique selling points, which means pointing out to the features that are going to be advantageous if the client accepts them. Look, the unique selling point will depend on whatever it is, but we're just talking about something that gives you an advantage, something that, and it's not from your perspective, okay? It has to be from the supplier, rather from the buyer's perspective, because it's like, if you're selling a car, think of it this way, right? So you can sell a car and say this, it will move you from point A to point B. That's typically what cars do, right? But that doesn't explain why somebody will have to go and buy a Mercedes when they're in a position to afford, say, a Toyota. There has to be something that is uniquely Mercedes, or there has to be something that is uniquely Toyota. So, that's the thing. That's the thing you bring out. Something else that you want to do in this case will include regarding your pricing. So make sure that your pricing is competitive and transparent. Okay, and this can be achieved by a clear breakdown of costs and highlight the value for money aspects of your proposal. And finally, highlight your compliance with industry standards and certification if such are a big deal in that industry. Remember, things like, okay, for example, in supply chain, so things like security, okay, the ISO 28000, or things like basically that supply chain management, or rather risk management in supply chain, okay, so 31000. So all that stuff, it depends. Again, it sort of just depends on the, what is it called? It depends with the tender, or rather with the contract or the tender that you're bidding for. So that's the thing. So if it is financial experts, okay, rather if it is financial assessment, you know what to do. If it is technical experts who are looking at it from a technical perspective, you know what to do. Okay, so let's move on to the next one. Capacity assessment, okay, is the last one. And in this case, this assessment is closely linked to the technical assessment, because the idea is just to check if you're actually capable of doing, or rather if you have the capacity to do what you said you're going to do. So it can be like, yeah, I can supply 3 tons of whatever it is. Maybe you can't. Maybe you're just hoping to get the tender so that you can resell it. Okay, the whole tenderpreneur thing. So in this case, they'll be looking at financial visibility of the supplier to ensure that they can purchase raw materials. That's an example. Do you have guarantor or insurance in case things go wrong? I mean, all those are just things that they're looking out to ensure that your position, okay? The claim you're making that I can take care of this thing. Are you really in a position to do that? And so 3 things, okay, we've talked about in this video. Just say that as far as the tender is concerned, okay, they might evaluate it in terms of finances. They might evaluate it in terms of the technical details required. And they might evaluate it in terms of capacity. And then the things that you can do to increase the odds of you winning that deal. But still, that doesn't really make sense. Those things don't really help you if you don't even understand the tender process. If the only thing you know is, I'm capable of doing a software and therefore I want them to give me that deal. You need to understand the tendering process. So if you're struggling with that, or rather if you're interested in knowing the tendering process, then you can check out that video, okay? And I've also linked it in the description. That will help you to understand the process of tendering, okay? What organizations go through. And by knowing that, well, you know how you can manipulate your way into getting that deal. All right, see you in the next video.